But here's what they're not telling you. A mining company just released their earnings. They sold silver for $70 per ounce, while the paper market still showing $55. That's a $15 gap. The Trump administration just confirmed a sophisticated price floor mechanism, and the COMEX vaults draining at 20 million ounces per month. Mathematical models are screaming March 6th. That's 15 days from today. 15 days until... listen, if you've made it this far, you're exactly where you need to be. Welcome to Currency Archive, the only place giving you the real story, the one Wall Street doesn't want you to hear. Now, I need you to do something for me. See that subscribe button down there? Yeah, that red one. Press it. Like you're dialing a rotary phone back in the 70s. Remember those? One firm press with authority. Because what I'm about to show you, you'll want to catch every single update before it's too late. And hey, drop a comment right now. Tell me, where in the world are you watching this from? New York, London, Mumbai, Tokyo? Because this silver situation, it's not just an American problem anymore. This is global. Now let's get into it. The numbers didn't make sense. In the final quarter of 2025, a mining company called First Majestic Silver published their earnings report. Buried in the financial documents was a single line that changed everything. The company had sold their silver for $69.74 per ounce. At the exact same time, the COMEX exchange, the world's dominant silver trading platform, was showing a price of $55.20 per ounce, a $14.54 difference for every single ounce. This wasn't a small discrepancy. This was a 26.3% gap between what miners received for physical metal and what the paper market claimed silver was worth. Financial analysts immediately recognized something was wrong. In normal commodity markets, premiums exist. A buyer might pay $1 or $2 more per ounce for physical delivery, sometimes $3 during periods of high demand. But $14.54? That number violated every principle of efficient market theory. The mining company wasn't an outlier. Other silver producers began reporting similar figures. Physical buyers were paying vastly more than the paper price suggested they should. The pattern was consistent. The gap was widening. And nobody in mainstream financial media was talking about it. Then, the Trump administration made an announcement in a statement that received surprisingly little coverage. Officials confirmed they had identified what they called sophisticated market control mechanisms affecting silver prices. The language was careful. The implications were explosive. For the first time, a sitting administration was acknowledging that silver prices were not determined by natural supply and demand. They were being controlled. The business community had suspected price manipulation for years. Traders whispered about it. Small investors complained about it. But suspicion and proof are different things. Now, the evidence was undeniable. Mining companies were selling physical silver for $70, while paper contracts traded at $55. The math didn't lie. To understand why this matters, one must understand what realized price means. When a mining company digs silver from the ground, they sell it to refiners, industrial users, or bullion dealers. The price they actually receive, the cash that enters their bank account, is called the realized price. This is not theoretical. This is not speculative. This is the real transaction price in the physical market. The COMEX spot price, by contrast, is determined by futures contracts. These are paper agreements to buy or sell silver at a future date. Most of these contracts never result in physical delivery. They are settled in cash. Traders buy and sell these contracts based on leverage, momentum, and algorithmic trading strategies. The paper market dwarfs the physical market by a ratio of over 100 to 1. For decades, the paper price and physical price moved together. The futures market was supposed to reflect physical reality. It was supposed to provide accurate price discovery. That relationship had broken down. The $14.54 gap represented something more dangerous than simple market inefficiency. It represented a fundamental disconnect between financial markets and physical reality. Industrial companies were making purchasing decisions based on COMEX prices that bore no relationship to what they would actually pay for metal. Investors were valuing mining companies using spot prices that understated true revenue by 26%. The entire pricing architecture of the silver market had become fiction. The Trump administration's confirmation added official weight to what the numbers already showed. The word sophisticated was significant. This wasn't accidental. This wasn't the result of temporary supply disruptions. This was, according to official assessment, a designed system of market control. The implications extended far beyond silver. If prices in a major commodity market could be systematically controlled, what did that mean for other markets? If paper contracts could diverge this far from physical reality, what did that mean for price discovery in gold, oil, agricultural commodities? If a major exchange's pricing could be manipulated for years without intervention, what did that say about market regulation? But the most urgent question wasn't philosophical. It was mathematical. The paper market had created an artificial price ceiling. That ceiling had discouraged mine development, encouraged industrial consumption at artificially low prices, and attracted massive investment demand from buyers who recognized the gap. Now, the physical market was breaking away from paper control, and the inventories that backed the paper system were vanishing. 20 million ounces per month were draining from COMEX registered vaults. At that rate, mathematical models showed a terrifying date, March 6th, the day the vaults could hit zero, 15 days away. The discovery phase was over. The crisis phase was beginning. The system was elegant in its complexity. For years, market observers had asked a simple question. How could silver prices remain suppressed while demand surged and supply tightened? The answer, it turned out, was not found in mines or vaults. It was found in the architecture of paper markets themselves. The Trump administration's use of the term sophisticated was precise. This was not crude manipulation. This was financial engineering at the highest level. At the center of the system sat 8 major banks. These institutions held concentrated short positions in silver futures, positions so large that their trading activity alone could move markets. The CFTC's own data, publicly available in their weekly commitments of traders reports, showed this concentration clearly, week after week. The same pattern appeared. When silver prices began to rise, massive short positions would materialize, selling pressure would flood the market, prices would retreat. The mechanism relied on a fundamental characteristic of futures markets. For every ounce of physical silver, over 100 ounces of paper silver traded on COMEX. This ratio created leverage. A relatively small amount of paper selling could overwhelm any amount of physical buying. The tail was wagging the dog. The trading patterns were not random. Analysis of price movements revealed consistent suppression during specific windows. When Asian markets closed and before European markets reached full liquidity, silver would often face concentrated selling. When options expiration dates approached and large numbers of call options were at risk of finishing in the money, prices would mysteriously decline just enough to keep those options worthless. The timing was too consistent to be coincidental, but timing alone didn't explain the system's stability. The real genius was in the feedback loop. Industrial users, from solar panel manufacturers to electronics companies, based their purchasing decisions on COMEX futures prices. When paper prices remained low, these companies felt no urgency to secure long-term supplies. They operated just-in-time inventory systems, confident that silver would always be available at current prices. This behavior reduced immediate physical demand, which reinforced the paper price suppression, which further discouraged stockpiling, a self-reinforcing cycle. Mining companies faced the same distorted incentives. When silver traded at $55 per ounce on paper, investors questioned why miners couldn't produce silver profitably at that price. Never mind that physical buyers were paying $70. Financial analysts used futures prices to value mining stocks. Capital became difficult to raise. Mine expansion projects were delayed or canceled. Supply growth stagnated, not because silver wasn't valuable, but because the price signal had been artificially suppressed. The price floor system that Trump officials referenced operated through a different mechanism. When physical buyers attempted to take delivery from COMEX, they encountered obstacles. Delivery procedures became complicated. Wait times extended. In some cases, cash settlements were offered instead of metal, often at premiums above the futures price but below the true physical market price. This created a boundary. Physical buyers could get metal, but only by accepting delays and complications that made COMEX delivery impractical for most purposes. The result was market segmentation. Paper silver traded in one world with one price. Physical silver traded in another world with another price, and the gap between them grew wider. Banks maintaining large short positions faced theoretical risk. If too many contracts demanded physical delivery simultaneously, these institutions would need to source metal at physical prices while being obligated to deliver at paper prices. The losses could be catastrophic, but the system had a safety valve. COMEX rules allowed cash settlement under certain conditions. If physical supply became genuinely constrained, the exchange could simply declare a force majeure event and settle contracts in dollars rather than metal. The shorts would never face unlimited loss. This protection created asymmetric risk. Longs who bought futures hoping to acquire physical metal faced the risk of cash settlement at paper prices. Shorts who sold futures they couldn't deliver faced limited downside. The playing field wasn't level. Algorithmic trading amplified these dynamics. High-frequency trading systems, responding to price momentum and technical indicators, would accelerate moves in whatever direction the market was heading. When concentrated short selling pushed prices down, algorithms detected the momentum and added selling pressure. The initial manipulation triggered cascading effects that multiplied its impact. For years, the system maintained equilibrium. Paper prices stayed suppressed. Physical buyers paid premiums but found supply. Shorts maintained positions without facing delivery demands. The gap between paper and physical remained large enough to profit informed players, but not so large as to break the system entirely. Then something changed. The gap widened beyond historical norms. First Majestic's 69.74 realized price wasn't an anomaly. It was evidence that physical buyers had become desperate enough to pay any premium necessary. Industrial users who had relied on just-in-time inventory suddenly couldn't source metal at quoted prices. Investment demand surged as buyers recognized the divergence, and most critically, the registered inventory that backed the paper system began draining at accelerating rates. The mechanism that had controlled silver prices for years was encountering physical reality. Paper contracts were infinite. Physical metal was not, and when an unstoppable force meets an immovable object, something has to break. The vaults were speaking. The question was whether anyone was listening. The warning signs had been flashing red for months, but nobody wanted to believe what they meant. Deep beneath the streets of New York, in heavily secured vaults, sat the physical silver that backed the paper contracts traded above. These weren't theoretical stockpiles, they were real bars, stamped and serialized, registered with COMEX as available for delivery. The inventory reports were public. Anyone could see the numbers, and the numbers were screaming. January 2025 began with 87 million ounces in registered inventory. By February 2026, that figure had collapsed to 47 million ounces. 40 million ounces had vanished in 13 months. The drain wasn't slowing, it was accelerating. 20 million ounces per month were now leaving the system. The mathematics were brutally simple. At current drainage rates, registered inventory would reach zero by March 6th. Not might reach zero, would reach zero. This wasn't speculation, this was arithmetic. But the crisis went deeper than simple subtraction. COMEX inventory existed in two categories. Eligible silver sat in approved vaults but wasn't registered for immediate delivery. Registered silver was committed, ready to be delivered against futures contracts. The distinction mattered enormously. Only registered silver could fulfill delivery demands, and registered silver was evaporating. What made the situation more precarious was the ratio. Total open interest in silver futures represented claims on over 900 million ounces. Registered inventory stood at 47 million ounces. That meant paper claims exceeded available physical metal by a factor of 19 to 1. If even 6% of contract holders demanded delivery, the system would collapse. The physical market was already fracturing. Retail dealers across North America reported unprecedented premium expansion. Silver Eagles, that normally sold for $3 over spot, were commanding $12 premiums. Maple Leafs showed similar spikes. Generic rounds and bars, typically the tightest premium products, were $8 over paper prices. These weren't brief spikes. These were sustained structural shifts. In Europe, the situation mirrored North America. German dealers reported allocation systems where customers placed orders and waited weeks for delivery. Swiss refineries, normally operating with seamless just-in-time fulfillment, began quoting extended lead times. The Royal Mint in Britain implemented purchase limits on certain products. Asian markets showed even more dramatic stress. In India, where silver holds deep cultural significance for weddings and festivals, physical premiums exploded to $18 per ounce above COMEX. In China, where industrial demand dominated, manufacturers reported difficulty securing supply at any price. Smuggling activity intensified as arbitrageurs attempted to exploit regional price differentials. The wholesale market, where major dealers and institutions traded, revealed the deepest cracks. Conversations that should have taken minutes now required days. Sellers demanded immediate payment before committing inventory. Buyers insisted on inspection before transfer. Trust, the invisible foundation of wholesale markets, was eroding. When 1,000-ounce bars changed hands, both parties now verified weight and purity regardless of recognized refiner stamps. The market was reverting to physical verification because paper assurances no longer sufficed. Industrial users faced a different nightmare. Solar panel manufacturers had built production plans around $55 silver. They suddenly confronted $70 acquisition costs, a 27% input cost increase that shattered profit margins. Electronics companies that assembled products with tight cost structures found themselves squeezed between contracted selling prices and surging material costs. Automotive manufacturers developing electric vehicles, which required significantly more silver per unit than traditional cars, began redesigning component specifications to reduce silver content. The supply response that economic theory predicted wasn't materializing. Mining executives explained why. Bringing a new silver mine from discovery to production required 7 to 10 years. Expanding existing operations took 2 to 3 years minimum. Even if miners broke ground today, responding to $70 physical prices, that supply wouldn't reach market until 2028 at earliest. Meanwhile, existing mines faced their own constraints. Ore grades were declining at many operations. Energy costs were rising. Labor shortages persisted in remote mining regions. Maximum production capacity was essentially fixed in the near term. Primary silver mines, those where silver was the main product, represented only 25% of global supply. The remaining 75% came as byproduct from lead, zinc, copper, and gold mining. These operations made decisions based on their primary metal. If copper prices didn't justify expanded production, the silver byproduct didn't increase regardless of silver prices. Investment demand was surging precisely when industrial demand remained elevated. Wealthy individuals who understood the manipulation dynamics were converting paper wealth into physical metal. Family offices were allocating to silver as monetary insurance. Even some institutional investors, traditionally confined to paper instruments, were exploring physical holdings through allocated storage programs. Each new buyer removed metal from available supply. The feedback loop was vicious. As registered inventory declined, sophisticated traders recognized the delivery squeeze potential. This attracted more speculative buying, which increased delivery demands, which drained more inventory, which attracted more attention. The cycle fed itself. Central banks added another layer of complexity. While gold reserves were substantial and well documented, silver reserves among monetary authorities were minimal. Most nations held little to no monetary silver. If countries decided that silver deserved strategic stockpiling, even modest national purchases would overwhelm available supply. A single mid-sized nation acquiring 50 million ounces would exceed current COMEX registered inventory. The Trump administration's confirmation of market control mechanisms had unintended consequences. By validating what informed observers already knew, officials triggered a confidence crisis. If silver prices had been manipulated, what else was manipulated? If major exchanges couldn't provide reliable price discovery, where could market participants find truth? The announcement that was meant to signal reform instead accelerated the crisis it revealed. March 6th loomed not as prediction, but as mathematical destination. The inventory trajectory was clear. The drainage rate was documented. The physical market had already separated from paper. All that remained was the final accounting. And when registered inventory reached zero and the system faced a choice it had avoided for years, deliver metal that didn't exist or admit the paper was worthless, the crisis wasn't coming. The crisis had arrived. Most participants just hadn't realized it yet. The silver market was not an isolated system. What appeared to be a precious metals crisis was actually a stress test of something far larger, the integrity of commodity price discovery itself. When Trump administration officials confirmed sophisticated market control in silver, they inadvertently raised questions about every other futures market. If silver could be manipulated for years without intervention, what prevented similar control in gold, oil, copper, agricultural commodities? The answer was nothing. The mechanism was identical. Paper contracts vastly outnumbering physical supply. Concentrated positions among major banks. Algorithmic trading amplifying directional moves. Settlement rules favoring cash over delivery. The architecture existed across commodity markets. Institutional investors began asking uncomfortable questions. Pension funds held commodity futures as portfolio diversifiers. Endowments allocated to commodity indices for inflation protection. Sovereign wealth funds maintained strategic commodity exposure. All of these positions assumed that futures prices reflected physical market reality. The silver divergence proved that assumption was false. The contagion risk was not theoretical, it was mathematical. Consider a pension fund hedging inflation risk with a commodity basket. If the futures prices in that basket were systematically suppressed, the hedge wasn't providing the protection the fund believed it had. When inflation accelerated and physical commodity prices surged, the fund would discover its paper positions settled at controlled prices while real-world costs followed physical markets. The protection would fail precisely when needed most. Insurance companies face similar exposure. They use commodity derivatives to hedge various risks in their underwriting portfolios. If those derivatives no longer tracked physical reality, their risk models were wrong. Capital allocation decisions based on faulty models would produce unexpected losses. The cascade effects could be substantial. Banks themselves faced a different danger. Those holding large short positions in silver had presumably hedged those positions through various means, but if physical delivery demands exceeded expectations and registered inventory reached zero, those hedges might prove inadequate. A single bank facing a delivery squeeze could trigger counterparty concerns that spread through the financial system. Lehman Brothers collapsed not from its direct losses, but from counterparty panic. The mechanism could repeat. The Trump administration's announcement of a sophisticated price floor system introduced new variables. The language suggested intervention, but the details remained vague. Price floors in commodity markets historically took several forms. Strategic reserves represented one approach. The government could purchase physical silver at specified price levels, creating a floor through direct market participation. This required capital, storage capacity, and clear policy objectives. It also required deciding what price level to defend and for how long. Regulatory intervention offered another path. CFTC could impose position limits that prevented concentrated short positions from dominating markets. This approach addressed the mechanism of control rather than the price level itself. But position limits faced fierce industry opposition and legal challenges. Implementation would take months or years. Emergency measures provided a third option. If COMEX registered inventory reached critical levels, officials could suspend trading, force contract settlement, or restructure delivery terms. This would prevent market collapse, but would also destroy confidence in futures markets as hedging instruments. The cure might be worse than the disease. Each approach carried consequences. Direct price support required sustained government spending. Regulatory changes faced implementation delays. Emergency measures triggered market panic. There were no clean solutions. Business decision makers confronted an environment where traditional risk management tools no longer functioned as designed. Companies that hedged silver exposure through futures contracts discovered those hedges didn't track physical prices. Firms that relied on COMEX quotes for budgeting found actual procurement costs vastly higher. The disconnect between paper and physical forced impossible choices. A solar panel manufacturer illustrated the dilemma. The company had contracted to deliver panels at fixed prices. Prices calculated using $55 silver. Physical silver now cost $70. Each panel produced generated a loss. The company faced three options: break contracts and face legal liability, fulfill contracts and absorb devastating losses, halt production and lay off workers. None were acceptable, yet one had to be chosen. Electronics companies faced similar mathematics. Automotive manufacturers, redesigning vehicles around silver-intensive technologies, confronted cost structures that no longer made sense. The manipulation had distorted planning across entire industries. As the suppression ended, those distortions created casualties. Investment firms managing client portfolios faced fiduciary questions. If silver was demonstrably manipulated, and clients held silver mining stocks valued using manipulated prices, did fiduciaries have an obligation to adjust holdings? What about commodity funds, holding futures that didn't track physical? The legal exposure was murky. The ethical obligation was clear. The timeline added urgency to every decision. March 6th wasn't arbitrary. It was the mathematical projection of current inventory drainage. 15 days remained for market participants to assess exposure, adjust positions, and implement hedges. 15 days to recognize that the rules had changed. 15 days before the system confronted zero registered inventory. History offered limited guidance. Previous commodity squeezes typically involved temporary disruptions. Weather events affecting crops, labor strikes interrupting production, geopolitical conflicts disrupting supply chains. Those squeezes resolved when the temporary factor ended. The silver situation was different. This was structural. The paper market had created claims that physical supply could never fulfill. The resolution wouldn't come from increased supply or decreased demand. It would come from price adjustment, forced delivery settlement, or market structure collapse. Prudent risk management in this environment required acknowledging uncomfortable truths. Futures prices were controlled. Physical prices reflected reality. The gap between them represented systemic fraud. Official confirmation changed nothing about the underlying mechanics, but it changed everything about the information available to decision makers. Businesses dependent on silver faced a binary choice: continue operating as if paper prices meant something, or acknowledge physical market reality and adjust accordingly. The former preserved short-term comfort, the latter required immediate painful decisions. But comfort based on false prices was not safety, it was denial. Investors confronted similar logic: paper silver instruments, futures contracts, ETFs that settled in cash rather than metal, carried counterparty risk that most holders didn't recognize. When the system broke, and it would break, those holding paper would receive settlement in dollars at controlled prices. Those holding physical would own an asset whose price was no longer suppressed. The Trump administration's involvement added a political dimension. Price floors suggested government support for higher silver prices. That support might stabilize markets. It might trigger inflation concerns. It might face congressional opposition. The uncertainty itself created risk. Markets hate uncertainty more than bad news. The broader implication transcended silver. If major commodity markets could be controlled through paper manipulation, and if that control could persist for years before official acknowledgement, then price discovery in financial markets was fundamentally compromised. Every risk model, every hedging strategy, every investment decision based on market prices incorporated a hidden assumption: the assumption that prices were real. Silver proved that assumption was false. What happened next would determine whether this was an isolated crisis, or the first domino in a broader systemic failure. The mathematics were clear. The timeline was fixed. The inventory was draining. March 6th was coming. The only question was whether decision makers would act on the evidence before them. or wait for the crisis to force their hand. History suggested most would wait. Mathematics suggested waiting was the worst possible choice.